Today's our guest speaker, Kevin Jenkins, Vice President of Northmark Capital, Charlotte Regional Office. Welcome, Kevin. And today's topic will be on latest trends in multifamily lending space. So you can take it from here, Kevin.
Well, good evening. Appreciate everybody joining. We'll make this try to make this as quick as possible. Try to hit some high level stuff, and then if you got any questions, be happy to answer that. Just from an overall general perspective, I would tell you, since the beginning of the year, everything slowed down a great deal. Acquisitions aren't going really anywhere unless you've got a lot of equity. Doesn't make any sense to do any bridge deals right now. I think there's deals potentially to be had, but I think they're probably 1 in 20 or 1 in 50 as opposed to as fast as they were going over the last 2, 3, 4 years. A lot of that's been driven obviously by the increase in interest rates, especially from the permanent standpoint, and the debt service coverage is limiting how much dollars we can get on the permanent side. The pricing has still a little out of whack based on where the debt's coming in. So typical leverage is probably in that 65% range, where it used to be 75, even 80% back in certain time frames. So a lot of that, and again, a lot of that's driven by the acquisitions over the previous 3, 4, 5 years or 2 years. Just based on where interest rates were on people getting bridge loans, their ability to try to refinance those out or even sell those to a potential buyer that's able to get favorable debt at very low interest rates in the past. All that kind of changed about the fall of last year and kind of rolling over into this year with rates continuing to increase, which is making it not very opportunistic, I would say, or harder to find deals than you have had in the past. Currently looking at some refinances for some guys that have loans coming up. That's probably a majority of what we're seeing. We cover mainly the Southeast, mainly the Carolinas and Southeast, but we're also looking at stuff in the Midwest and West. And ironically, it's the same kind of everywhere. It's interest rates are having a big factor on what you can and can't get done, and how much equity you really want to put into the deal. I don't believe the quote unquote value add deal is, I don't want to say there anymore, because you never say never, but it's more particular to a deal depending upon how the current owner or seller has maintained or operated that property up until that point. It's kind of going back to the days prior to 2008, when you only got bridge deals for really underperforming properties. Now, as we move along into the year, will some of that be needed because of the current leverage people have on deals? And maybe. We just have to see how everything kind of shakes out. But everything's kind of slowed down. Again, just refinances, as far as we're concerned right now. A couple acquisitions we're looking at, nothing really definitive. Did do a smaller deal earlier this year, excuse me, on an acquisition, but ironically, they got that kind of tied up prior to the end of the year. We just ended up closing after the first of the year. So I think it's I don't think there's as many deals out there, or if it is, they're probably just putting it out there to see what they think they can get, as opposed to refinancing, because their debt's probably coming due or getting ready to come due in the next year or so. So they got to start planning what they want to do with that deal with respect to the debt piece going forward. And whether it's to sell it or refinance it, a lot of that may be dependent upon where they are in their business plan, what they think they can get, and how many actual buyers are really out there searching for deals. as far as who's lending money right now, the agencies are still active in pursuing deals and wanting to do deals. But again, they're going to be more on the debt service constrained platform or the permanent loan. There are a couple of bridge lenders out there. There's several that have gotten out. And there are a couple of fixed rate bridge lenders out there, but you're paying, I'd say 7.5 to 9+%, depending upon that bridge lender and depending upon the circumstances. So I think you better be buying it at a good price or a good basis to make it make sense. Otherwise, you're still trying to figure out what you're going to do with that deal at the end of that term, and where interest rates may or may not be 2-3 years from now, much less where they are today. But that's kind of the general overview. I'd say multifamily, as far as product type goes, multifamily is getting done. Some industrial is getting done. I've seen some smaller retail get done. But as far as office, unless it's medical, I'm not seeing a whole lot of office get done at all. A lot of that's been hit by the COVID over the last couple of years. Most people are still staying home. Several deals I know, large office buildings, at least here in Charlotte, have gone back to the lender. So from that standpoint, it's really from a multifamily perspective and an industrial perspective. Retail, if you got a good credit tenant or you got a grocery anchor, you could probably get some of that done. Or if it's lower leverage, it may be able to get done. And a lot of these smaller deals are being done by some banks, but you got to sign your name to it, so you got recourse on it. So that's kind of a general view of where I see things. I as far as the rest of the year, personally, I think it's going to be much of the same thing we've had. The Treasury hadn't moved a whole lot over the last week or so. Now, will it move based on what's going on in Washington? Yeah, I don't know. But your permanent rates are still around the 5.5, give or take, depending upon leverage. Your smaller multifamily deals are going to be in the 6% plus range. And I kind of foresee that going throughout the rest of the year. I will also say that there are several of our life companies that have pulled out of the market, at least for the time being. So as far as the overall scope of lenders, they're kind of dwindling a little bit, just to kind of see where the market goes and when they may enter back in, if they enter back in for the rest of the year. So it's a lot of moving parts, depending upon the deal you're trying to get done. But I think overall there's probably a fit somewhere. But in reality, it's based on how much equity do you want to bring to the table. And that's really the name of the game right now, because everything I'm seeing and several of my colleagues are seeing is the numbers just aren't matching up. And if they are, you've got to put a lot of equity into it to make the deal work, especially on an acquisition. Now, refinances, if you've had them for a while, over the last 5 years, or you really increased rents, you could probably get a good bump there and maybe look at refinancing if you need to. With the movement in interest rates going up, that could help your prepayment penalty on the back end. So a lot of it really depends on what you're trying to do with the property. If you're trying to get rid of it, if you're trying to refinance it, just hold steady. Just whatever it is you may or may not be trying to do with that piece of property. The debt is a piece of that is going to be challenging, I think, for the remainder of the year and may even roll into next year. You never know how things are going to play out. But I don't necessarily see a whole lot of deals prospectively coming on the market in the fall or after the summer mainly because of the increase in interest rate, unless things really take a turn. But I'm just not seeing pricing come down far enough yet to where a lot of deals make sense, at least from a number standpoint. Now, we can argue about some other pieces of it, but from a purely number standpoint, the what's being asked on a pricing standpoint versus where your debt's coming in, there's still a big delta there to fill, and that's got to be filled with equity. So that kind of gives you a big overview of what I'm seeing on a day-to-day basis, trying to look at deals or trying to help people through various things. I just tell you, I think there's going to be some challenges for the next 6 months or so with financing and how that's going to play out.
Awesome. Yeah. Thank you, Kevin. Thank you for giving some kind of overview. So you mentioned few like challenges. Would you also add any other challenges you're observing or you're seeing current debt or multifamily market side?
Again, the biggest challenge I'm seeing is pricing. And when I say pricing, I mean the price you've got to pay for it to get the deal happen, or to make the deal work. It's again, especially on an acquisition, because with the debt service constraint you have with the permanent side, we're being limited on what we can and can't loan you. Now, another key component that I'll bring up, and I'm sure those with with current deals probably already know this, but insurance is also becoming an issue as well. Renewals on insurance premiums, and in my view, have gone up not 3, 4, and 5%, but more like 20% or 30%. We're in the process of refinancing or starting to refinance a deal now. And in talking with the borrower today, he was asking me what we were using for insurance, and I told him, and he said we got to add more to that because it's going way up. And I've heard from other clients that had deals that when they get their insurance quoted for the next year, it's gone up tremendously, and so they're asking me what to do. My main thing is maybe you try to find another broker to quote it for you, but outside of that, I mean, the insurance is going to be what the insurance is going to be because the lender's got the certain requirements. But I'm seeing that become an issue because it's gone up quite a bit, and it's gone up more than, say, some of the rent increases have gone up. But that's a key component that is outside of the tax issue stuff in certain states when you buy property. The insurance is probably a big factor where you used to not have to worry too much. You could probably estimate kind of what range you're going to be in. But now it's almost like when I'm talking to folks, if they've got it quoted from somebody and kind of where that's landing. So insurance is an item to be aware of because it's not, $250 to $300 or $350 a unit anymore. It's more like $400, $500, and $600 a unit, depending upon where you are and how old your property is, and et cetera, et cetera. So to me, that's a big factor that's causing some. I don't think it's not causing deals not to work, but it's just one of those extra items that if you're budgeting $300 a unit in your analysis, and it really should be $500 to $600 a unit, it just means you're going to have to bring that much equity. And if you haven't planned on that, that could be a surprise for you. So that's a outside of the movement and where rates are going to be and all that, insurance is an issue. I'm hearing from a lot of people, a lot of clients, those both on the refinance side and the acquisition side. So
yeah, definitely I do see that, from insurance point of view, definitely is going up 500 to 600 range. Yeah, it's a very, very great point. And
yeah,
so next question, like, let's say if, like as an investor, if I share like T12 or Rentro or something, So what are the key parameters you would look in any deal, from market point of view or deal point of view or any T12 or rentals point of view?
Well, from a rent roll perspective, obviously we're looking to see if it's occupied and kind of where the rents are. But we're not. I'm not doing any projecting or value add deals right now. I mean, yes, we can do it. I just don't know if it makes any sense right now because you're not getting any benefit. The benefit before was that you got bridge loan money because you got a lot more proceeds that you can get on the permanent side. Well, that's taken away now by where interest rates are. So you're 65% of cost on a bridge loan, you're 65% of cost, say you're doing an acquisition, you're 65% on a permanent loan, but you're paying 5.5 versus 8. It's really not, in my view, at least on the deals I've seen so far, it doesn't make a whole lot of sense to do any bridge type lending at this current environment, especially if you're having to pay a much higher price than where, say, the permanent loan should really put it. Now, if there's a lot of vacancy, if there's a lot of deferred maintenance and you can buy it right, meaning that your upside is going to be you going in there and fixing all these problems, but you're paying a quote unquote discount because it's got all these problems, then maybe there's an opportunity there, but not at a market rate price. I mean, that to me, that's got to be at a discounted price to make it make sense because of what you're having to pay there. On the T12 and rent roll, we're looking for things that either say on the income side or one-time items. Maybe you got an insurance policy. So you got your roof done, you got insurance money for that. One-time items for cable. Any large items we're seeing on the rent roll, we're asking questions about. I mean, on the T12s, we're asking questions about that. Just so we're not overstating the income and or overstating the expenses. Yeah, a lot of folks on the T12 put their capital improvements into repairs and maintenance. So if we see a deal where you've got $1,500 or $2,000 a unit in repairs and maintenance, we're going to start asking questions. Is some of that really for capital expenses? So we kind of peruse through stuff like that and see if they're meeting kind of some of the metrics we look at on a similar type property that say we've done before.
Got it. Yeah. Thank you for sharing that. And also, can you give me some kind of high level overview about, term sheet, like index, spread, so far, all this stuff,
Well, most of the stuff I'm quoting off of is the 10-year treasury, mainly because that's where most of your larger proceeds are going to come from. We can certainly do shorter terms, but if you do shorter terms, that kind of digs into your proceeds a little bit, just because we do a refinance test on the back end after the term, at the end of the term, to make sure it can still get done. We can still refinance it at the end of that term. So most of the time I'm quoting off the 10-year, which today is about 370. I mean, if your loan amount's north of 7.5 million and you're in the 65% levered loan to value range, you're going to be in the 175, 180 spread range. If for whatever reason you can get a higher levered deal and the numbers make sense, you're probably in the 200, 205 range. Interest only is available. I will tell you it's pretty customary to get 3 years of interest only. You could potentially get more. A lot of that may have to come from either a waiver or just a request. Again, depending upon what the need for the additional 2 years of interest only is for, and whether it makes sense, again, from a refinance test standpoint, because if you're not paying anything down for 5 years and I've only got 5 years of amortization, you may not be paying that much principal down. Therefore, yes, you can get 5 years of interest only, but it may it may dilute your proceeds a little bit going in on the front end. So it really depends on what matters more to you. Is proceeds a big driver, or is interest only a big driver, or is interest rate a big driver? Because with interest only comes a little bit of adders for the interest only period. Not much, probably a basis point or two per year, but it's still every little bit adds up, especially when you're dealing with higher loan amounts. Everything I'm seeing right now, Rama, from a loan to value standpoint, is probably in that 65% plus or minus range. And that really doesn't matter whether it's a large loan or a small loan. It's just kind of where things are sizing right now. Whether it be a refinance or an acquisition, just because of where people think their value is. So I would tell you that's kind of the norm right now. That's not to say that you can potentially find a 70% loan to value or even 75% loan to value deal. I just haven't seen those in the first 5 months of the year. To be honest with you, it's everything's trading in that 65% plus or minus range. So and therefore, again, you get the benefit of the lower spread, but you still got to come up with 35% equity, especially if you're buying plus closing costs. So it's if you're buying a deal, and plus any sort of capital improvement if you plan on doing any sort of improvements to the property. So, but again, because we're debt service constrained, that's where things are kind of shaking out, or what we're seeing.
Got it. Yeah. Thank you again. So, and how do you see like next 12 to 18 months or 12 to 24 months, Kevin?
Well, as I think the next six months are going to be about the same. Now, after that, I think, I think a lot depends on where interest rates go, and or where sellers are with respect to, do they want to hang on to the deal or do they just want to get rid of it? As an example, if you've got a bridge loan a year or two ago and you're coming up on your 2-year maturity or even 3-year maturity, say next year in 2024, you're going to have to make some decisions. And depending upon how well your business plan went or is going, do you sell it at some sort of discount to get out of it? Do you refinance it? And if you refinance it, are you able to get at least the bridge debt out? So I think depending upon how all that goes, may go largely on how more or less activity is going to be in the market. Because I think there's some people that are wanting to sell, but there's no buyers willing to pay the price that they've got it out in the market for. So if interest rates, I think, stay somewhat consistent, meaning they're not moving from, a 3% treasury one day to a 4% treasury the next day and so forth and so on. If interest rates stay kind of where they are, then I think you may see after the fall some things maybe kind of work themselves out. But again, I think that's largely based on whether or not you've got a group that really wants to sell or not. And again, a lot of it may depend upon how well they performed on their business plan. Were they able to get the renovated units done and rented for and increased rents in order to get that bridge lender out?
Got it. Thank you. Feel free to ask any questions, anyone. And any final thoughts, Kevin? Anything, any insights? How exactly investors can plan for next 6 to 12 months?
I would, the only thing I can tell you is, or the main thing I would tell you is keep looking at deals, but I would buy them based on how they fit within the permanent market. Size them to a fixed rate deal, whether that's a 5, 7, or 10-year deal, size them to that. I don't see bridge money coming down to 4% in the next 6 to 12 months. So to me, it's not, again, unless it's a really underperforming property, I don't see the need for doing a whole lot of bridge stuff. That's just my personal view on it. But as far as a buyer is concerned, if it doesn't size to a permanent deal going in day one on your numbers and the preferred and the particular returns you want to get, then I would keep looking. You don't want to get into a deal and pay for somebody else's problem, because all you're doing by doing that, all you're doing is taking over somebody else's problem. Now you got to deal with it. I would say store up your equity, because there could be, depending upon how things go, there could be some potential deals coming up. But a lot of that, I think, is going to be dependent upon how anxious the sellers are to get out of their current deal, and whether they have to get out of the deal or whether they can refinance it, depending upon how much pressure their bridge lender is putting on them to get out. So I would say, keep your equity dry, keep your powder dry, keep looking at deals, but buy smartly, buy correctly, based on how the numbers are, not any how it's performing today, not any sort of projections going forward. I think those days are kind of, even though I think a broker is going to continue to push that, say, hey, you can push these rents 100, 150, 200, maybe. From a number standpoint, I'm not seeing that right now.
Got it. Hi, Ed. Feel free to ask question.
Yeah, I got a question for you there, Kevin. This is Ed Modsell.
Hey, Ed, how you doing?
Good. Are there any alternative options other than bridge debt when you're looking at a deal that doesn't fit the requirements for agencies, let's say 80% occupied? Otherwise, it's a good deal, got a little value add. What would you recommend in that case?
Well, you can always try the local bank. But again, that's going to come with a recourse provision.
Yeah.
Outside of that, I mean, there are a couple, there are a couple life companies that have a debt fund or a bridge component. And there are a couple of still, for lack of a better word, I'll call them debt funds that are still out in the market. Outside of that, and again, this goes back to whether you want recourse on that or not. If it's a non-recourse issue, the only thing I can tell you is bridge money is probably going to be your best bet. I mean, there are hard money guys out there, but that's for the really problematic deals that the bridge guys won't even touch. So bridge is probably the debt fund guys, the the life companies that have that. That's probably your best alternative as far as other financing goes for those type of deals. Now, the size of the deal matters much more so on the bridge side. So if it's at least a $5 million or more loan amount, then I think you'll have some people interested. If it's below 5 million, it's getting harder and harder to do those deals, just because there's not as many players in that space as there once was.
Thank you.
Yes, sir.
How about like CMBS or mezzanine debt, Kevin?
CMBS is still out there. Their rates are a little bit higher. Quite frankly, I haven't done a CMBS deal in years. I mean, it's probably 5 years, more than that. But they're still out there, and they're a somewhat of, I'll call them somewhat of an alternative. I mean, I guess if you can't get it anywhere else, you can try there, but again, their rates are going to be in the 6.5, 6.25 range. So you're, again, for multifamily, you're still better going to either life company or agency. Again, unless those two can't or won't do it. But and there's, I do know a couple CMBS guys that are kind of hitting the pause button too. So I wouldn't say it's everybody, but I know a few that have said we're kind of pencils down right now. Just
Got it.
to see how things kind of flesh out here.
Yeah, yeah. So how exactly we can access life company related, debt?
I'm sorry, say that again.
How can we access life companies debt?
Well, we've got several life companies we represent. Now the thing about life companies is they're probably the most conservative lender that you'll find. So even back in the day when we were doing 75 and 80% for say agency, they were doing 65, 70% on their stuff. Now they typically like, I would say, newer, shinier stuff. So for them to get involved in the deal, I don't think they're going to be doing the 1970s built construction or the 1980s built construction. They may get into the 90s or 2000s, especially if you've renovated them and really brought up rents. But they're a lot more picky in what markets they'll go in, first of all, and how much leverage they'll do based on that particular age of the complex. So, but we can certainly put some deals in front of them if they kind of fit that criteria, and see if you got any takers. But again, they're going to be lower leverage on all their stuff.
Got it. Yeah. Thank you again, Kevin. Thank you, Ed, for asking questions. Yeah, next question from Ed. Have you used any credit unions?
I have not used credit unions lately. Again, the ones I've dealt with before come with a recourse component, and most of the folks I deal with want a non-recourse avenue. So I have not done a credit union deal in quite some time. They're still out there. I think they're a potential viable option, depending upon the credit union you go with. I think some are better than others, but they're certainly a potential option depending upon the size of the deal.
Any recommendations based on your experience? Any
recommendations?
Yeah, any good credit unions recommendations?
Well, the ones I've used over here on the East Coast or the Carolinas has been Coastal Federal Credit Union. There's a I'll have to get you his contact. He's kind of a, for lack of a better word, I'll call him a broker that kind of gets a deal and then goes out and has various credit unions that he kind of shops the deal to, and they participate in it. We've got a group that we do some servicing for out of it's on the West Coast called First Tech Credit Union. But again, that comes with a recourse component, and they'll do stuff all over the country. And I think they're 1 to 10 or 1 to 15 million. So those are the two or three ones that I would probably go to if somebody asked to go to a credit union. I'm sure there are a couple others out there. I just don't play in that space a lot.
Got it. Yeah.
And again, a lot of it is going to be dictated on where the property is located too. Because, for example, Coastal here in the Carolinas is not necessarily going to do a deal over in Texas. they may or may not go down to Florida, and they may do Georgia, but I don't know if how far some of these guys will go. Now, the one we do some servicing for out west, they go all over. So again, it really depends on where their deal is and what you're looking for.
Got it. Got it. Any other question, Ed, or anyone?
Yeah, I would want to find out what you think about or what you're seeing on the horizon for foreclosures. Well, what's happening in that area with probably mostly bridge lenders at this point?
Yeah, and Ed, I would tell you the short answer to that question is it depends, because I think a lot of it is going to be dictated on what I mentioned before is, does the seller or does the owner have to sell, or do they want to sell? And are they getting pressured by their bridge lender to get that deal off their books? And if they are, then I think you could see some, well, and before I say that, I also think it depends on how well they have performed on their business plan going into the deal. Because outside of so if you got a deal in say 2021, you still probably got a lower rate, at least going in, and you probably bought a cap, but your rate's gone up probably 300 basis points now. So how fast were you able to get your business plan oriented and in process in order to bump those rents up to be able to take that bridge lender out? Because I guarantee you, those guys that got bridge loans 2 years ago were estimating probably a 4, maybe 5% interest rate on the permanent loan, just from a standpoint of an analysis. And you're 50 basis points higher than that. In some cases, you're 100 basis points higher than that. So that's going to have a big effect on whether or not you can get it, at least excuse me, at least get the bridge lender out by refinancing, or you can sell. But if you sell, the buyer still got the same issue with the financing side. I mean, their rate's going to be no less than say 5.5, maybe 5.25, depending upon your leverage. But the point being is, it's just because you sell doesn't necessarily mean you're going to get the price you put it out there for, because Mr. Buyer's got to come in and get financing from somewhere, unless he's got a whole pile of cash. And typically that's not happening.
1031.
1031 guys. So, and the other part of that is, I think, how good or bad this gets also depends upon whether the bridge lender, I guess, how much they believe in that deal. Because I've heard, at least 6 months ago, I heard bridge lenders giving more extensions. Now, again, that comes with a cost. And I don't think those extensions are forever. So at some point, you're going to have to do something with the deal or something with the property. And what you do with it is obviously going to be affected by whether you can finance it either from the permanent side or sell it and have a buyer come in and put all that equity in. At least for now. If things continue the way they are and prices come in, you may see more and more people sell. But I don't know, Ed, if a lot of these guys that got into these deals, especially from a syndication standpoint, wanted to be long-term holders. Now they may end up having to be, and their investors may or may not like that, but that's better than giving the property back.
Right. The extension that you referred to, is that I know in bridge debts, we have a 3+1+1, or are you speaking of some other kind of extension?
Well, I'm speaking of exactly what you're talking about, the +1, but I'm saying it could be even, another +1,
Oh, gotcha.
depending upon how far back they got the bridge loan and how far they've come on their business plan. Obviously, the bridge lender's got to believe in the property and the sponsorship in order to give that extension. But I don't think the bridge lender is going to continue to extend that every year without seeing some sort of results. Or they may give you an extension and say, well, we're going to start amortizing now. So now instead of it being interest only, we'll give you the extension, but we'll put you on a 30-year AM or a 25-year AM or whatever it may be. And so I think a lot of that just depends on, excuse me, a lot of that depends on where they are on the debt piece and how much bridge debt they have to pay off. I think those factors are going to be involved in determining how much is going to be out there, whether it be just for a simple sale or going back to your question on whether a lender takes it back. And I think a lot of that's going to be dictated on those several items. Because right now I'm not seeing a whole bunch of deals go back to the lender. I am hearing, however, that a lot of the deals for the people I'm talking with, the deals they're looking at have bridge debt on it. Now they've got a little bit of runway, so they were smart to kind of get it out there, but I don't know if they're going to get the price they need to get in order to make that deal work like they analyzed it going into the deal. So again, do you now become maybe not a long-term holder, but at least, some sort of holder as opposed to, buy and fix it up and sell it. And I don't, a lot of that's going to be dependent upon what they can and can't get in the debt market. So I think it's yet to be determined, and it really depends on how some of these guys performed on their property.
Thanks, Kevin.
You're welcome.
Yeah, thank you, Ed, and thank you, Kevin. We went almost 15 minutes over. Really appreciate it. Yeah, so definitely good questions and good answers. Thank you very much.
Yeah, anytime. Happy to try to help where I can. I know it's tough.
Can you also share your contact details so that anyone can reach out to you?
Yeah, it's the best way to get me is my cell phone, which is 704-608-9756. And my email is kjenkins@northmark.com. Northmark spelled N as in Nancy, ORTHMARQ. So kjenkins@northmark.com. And then phone numbers 704-608-9756. And I can receive text. That's my mobile. It's the best way to get me. I can get text on that, check email, all the good stuff.
Awesome. Thank you very much, Kevin. I really appreciate it. And
No
thank
problem.
you, everyone. Thank you for your time. Thank you. And feel free to reach out, Kevin or me, if you need anything. Yeah.
Yep. Happy to help where I can. Appreciate you guys having me.
Yeah.